So thank you again. My name is Mike Fardy. I work as kind of head of distribution for the FlexShares business. FlexShares is the ETF arm of Northern Trust. So Northern Trust is a 129-year-old bank out of Chicago. We're running a little over $1 trillion. A lot of folks know Northern Trust. We have private wealth offices. We're a large custodian bank. Once again, running a little over $1 trillion under management. In 2011, they decided to launch an ETF lineup. And at the time, I'd say the ETF industry was kind of at the mid-stage of development. I've been working in ETFs for about 15 years. When I joined, there was only 6 ETF companies. There's now over 140 ETF companies. Assets went from, when I joined, a little under $100 billion to domestically about $2.4 trillion. When we launched our product set in 2011, the thinking was the world did not need another S&P 500 product. You didn't need another Russell 1000 product. We looked and said, let's look back at our history. Northern Trust always built a lot of customized indices, really trying to say, how do we build custom solutions? So whether it was a large pension, an endowment, there was a collective trust, it was a mutual fund, we decided, why don't we take some of that expertise and try to put it to work in the ETF space. So in our overall business, we have some larger pensions, we have some larger investments that screen for Catholic values. When you look directly at the FlexShare lineup, we don't have any specific Catholic value products, but it is a situation where with an ETF you have complete transparency. So groups like Trinity have the ability to screen our product set and say, okay, is this aligning with what we're trying to do, but also giving us a better exposure to a given product? I'm going to walk through one product, but before I do, I thought it might make sense to talk a little bit about our lineup in general, just so you get a better sense of our thinking. I said we didn't really want to come out with just market cap oriented products. Historically, we always looked at these things called factors, and factors are really characteristics of securities that give them kind of a tendency to perform in certain ways. And when you look at the academic studies, I think they've developed pretty rapidly over time. Gentlemen's Fama, French, and these factors, things like value and size, value stocks outperforming growth stocks over the long term, small cap outperforming large cap over the long term, high quality companies outperform companies of lower quality, dividend payers potentially outperforming non-dividend payers, low volatility names doing well. We looked and said, could you actually ever build a portfolio capturing some of these factors and factor premiums and put them together in a way instead of just building market cap oriented products? Because in many ways, when you look at the simplicity of an S&P 500 or a market cap oriented product, they represent a given part of the market, but just because a name like an Amazon or Google increases in value, do you want that to be a bigger part of your portfolio? What do you do in a late stage of a bull market when some of these names get really expensive? It's not really tied to the fundamentals of the underlying company. It's just, hey, it's more expensive because the price times the number of shares of outstanding have increased, so that's a bigger part of your portfolio. And at Northern Trust, we do think that's one of the things people need to be really aware of is how much risk is embedded in their portfolios. The ETF industry in many ways, I think, can become really daunting when you have north of 2,400 products. If you throw out an idea, is there an ETF for that? The answer is pretty much yes. The question is you have to be really careful to understand what's in it and what's underneath it. And in certain asset classes, do they trade well? Because the ETF industry has sliced and diced so granularly in many instances, a lot of investors probably didn't know that they needed a small cap Brazil product or a product that focuses on Turkey or some esoteric asset class. We've taken a little bit of a different approach at Northern Trust. We have 26 products in the FlexShares lineup, and we view them in kind of 4 broad categories. One being capital appreciation. People want to grow their money. Other people want to manage risk. A primary risk is inflation risk. Other people are trying to generate income. Other people are looking for liquidity. So we build outcome-oriented products, either looking at different factors and trying to get better exposure than a market cap weighted benchmark, or in areas like I'm going to walk through in a minute, in the risk management area, trying to get exposure to an asset class like natural resources, but do it in a better way. So it's trying to build a better mousetrap, taking advantages of some of the structural advantages of ETFs and indexing, but also saying, can you actually look at some of the rules-based processes, more of a fundamental active approach, and build better exposures at the end of the day, which is what we're really focused on. 2 years ago, we did launch a suite of ESG products, which is obviously relevant. In the ESG space, we've run some exclusionary strategies historically for Northern Trust, but we were finding more and more institutions were coming to us and saying, the problem with some of my strategies is I'm taking large tracking error relative to the benchmark, or I'm paying a price and I'm sacrificing returns to have my values. And we said, yes, there's probably a way where you can kind of invest for your values, but not give up returns. We did it in our launching of 2 products in the ESG space. It's easy to remember: ESG, which is our domestic product, and ESGG, which is our global product for us, where we said, what if we screened every company in the index and we looked at environmental, social, and governance factors using Sustainalytics and Bloomberg data. But we took the approach and said there are lots of environmental, social, and governance factors out there, but which ones have the tendency to either increase returns or reduce risk? And in so doing that, we were trying to make sure that we're either increasing returns or reducing risk. And you look at the solutions, they've done it, but we will stay sector neutral. So we'll have a tracking error less than 1% compared to the benchmark. Typically, the companies that screen better across environmental, social, and governance are also doing better from the standpoint of returns and risk reduction. In the areas of natural resources, and I'll focus a little bit on this one, we have a product called Gunner, which Trinity has looked at. They put it through their stock screening process, and by and large, we're able to give exposure to the natural resource asset class and do so in a manner where there's not a lot of kind of fails for companies that are violating Catholic values, which we thought was an important factor. Start moving. So when we looked at it in different ways to get exposure to natural resources, I think a lot of institutions will look and say, it's a hard asset class to invest in. You know, if you're a large foundation, if you're a large Yale University, you may be able to own timber, you may be able to own physical commodities. For the average investor, I think it becomes dramatically more difficult. In the 1990 or into the mid-2000s, you start to see a lot of investors start to look at things like futures and say, okay, I'm going to use futures to get exposure to areas of natural resources where there's commodity futures out there. The challenge is an asset class that used to be really low correlated to stocks and bonds, with all this introduction of futures, caused them to start to correlate more closely with broad stock returns. And that benefit of diversification through commodities suddenly started to diminish. So people like the asset allocation benefit. They like the ability to have a product that gives you an inflation hedge, but they start to look more like equities. We looked and said, we want to find a more elegant solution. So we looked and said, if you look in the world of equities, are you able to own equities and successfully build a very diversified portfolio? So the challenge with a lot of natural resource products or futures-based commodity products is they're heavily skewed towards energy. So in many ways, from a production-weighted standpoint, energy, particularly oil, represents about 70% of the production in the commodity space. That brings a lot of risk into portfolios. At FlexShares, we looked at the overall category and said, what if you could have more of a balanced product that was roughly 30% energy, 30% agriculture, 30% industrial precious metals, 5% water, 5% timber? You'd be able to have a much more diversified basket of securities, but you are doing a trade-off. Because when you own equities to gain natural resource exposure, your correlations are going to look closer to the S&P 500 or any broad equity index. So we looked and said, within the equity space, could you own companies that are more upstream? In the commodity or natural resource space, upstream refers to companies that are really pulling the resource out of the ground. So whether you're an integrated oil company or you're a company in the timber space where you own timberland, or you're metals from a gold miner to a silver miner, to folks that are actually pulling the resource out of the ground. is really important, and it allows you to get a closer correlation to the underlying commodity. It allows you to essentially give you a little bit more of an inflation hedge across our portfolio. So once again, we tried to set up a very diversified portfolio of securities. We did it under a global sense, in the sense we didn't want to just own the United States. We want to own a global portfolio and be tremendously diversified in what we were doing across it. Actually, I'm going to go backwards to a slide. Oops. So that diversification, I think, is one of the real key elements to how we selected and tried to build our portfolio. The nice thing with Trinity, they're able to say you can get exposure to a different type of asset class, but do it in an efficient manner. When you're not rolling commodity futures, you don't have to worry about the shape of the futures curve. You're not in a situation where you're getting a K1 vehicle where you're dealing with the tax challenges. You're owning the underlying equities, which means you have the ability to receive dividends. You have the tax efficiency of an equity structure relative to some of these other structures. But our point of view and the way Northern Trust thinks of this category that I'd say is real assets is usually somewhere between a 5 to 10% allocation for portfolios. So of a traditional portfolio, call it a 60-40 portfolio or an 80-20 portfolio, equity to fixed income, quite often we're finding a lot of people will fund this through their equity sleeve, but bring in not only natural resources, but bring in asset classes like infrastructure or real estate as inflation hedges. At Northern Trust and FlexShares, we really look at different time frames. If somebody wants a short-term in hedge against inflation, typically TIPS are the best investment vehicle to utilize. When you start to look at more of an intermediate inflation hedge, we'd look at an asset class like natural resources. For more intermediate to longer term inflation hedges, we'd look at real estate. And then finally, we would look at infrastructure as a way to get these longer term inflation hedges. So I think the nice thing, and I'll kind of bring this to close, in the ETF space, there's more tools than ever before. I think the challenge is with more options than ever before, there is a burden of due diligence in terms of understanding what you own. So the nice thing is with partnering with firms like Trinity, you have the ability to understand that, okay, these are being screened, not only from an investment management standpoint, but also screening for particular values as they're appropriate. Some of them will be natural, environmental, social, and governance screens. Other ones, I think you could look at them at broad-based asset allocations. But it's really critical at this point in time to understand how am I gaining that exposure, which is really the key. Northern Trust, we are not trying to cover every niche and cranny of the investing space. Once again, we believe clients are either trying to grow their money, manage risk, provide for income, provide for liquidity. We do have some additional information in the back of the room in terms of the entire FlexShares lineup. Once again, we're running about $17 billion. But to think of us, if you think of pure indexing over here, pure active management over here, these FlexShare building blocks are really in between a rules-based approach to build very deliberate exposure to certain asset classes. So I'll turn it back to Sam, but I really appreciate everyone's time and thank you for hearing from FlexShares and my partner in the back of the room, James Gibbons, as well, who is the local representative. Thank you, Sam. Appreciate it.